So looking at Europe, we think Europe is recovering really well at the moment. Economic growth is surprising on the upside. The ECB is still stimulating at the rate of 60 billion euros a month, and that liquidity is supporting both economic recovery and asset markets. So we've seen equity prices strong, we've seen real estate prices rallying from the disappointment of last year. Rental growth is beginning to increase, and the threat of deflation, which will be quite negative for real estate values in Europe, is receding. So that's all quite positive. In terms of the UK, that's a lot more difficult. Clearly we've got the terms of Brexit, which could be anywhere from 2 to 5 years from now. We know the government is quite split in terms of what sort of deal it wants to negotiate. Before the election we had the Prime Minister talking about no deal is better than a bad deal. Now we've got the Chancellor saying a deal that's good for business is better than no deal at all. So it's very hard to work out what is going to happen. We're not really expecting much concrete news in the next 12-18 months. So there's definitely going to be a transition period from the 2 years onwards. May run another 2 or 3 years, possibly as long as 2022, which will be when the next UK general election is. So I think that's going to create quite a bit of uncertainty. We've seen some reductions in growth forecasts in the last couple of months, which is not particularly positive for commercial property values. But on the other hand, if sterling were to weaken again, that makes UK, particularly London, commercial real estate more attractive to international investors. So there's a bit of a paradox that you win on one side and you lose a bit on the other side. So Europe obviously is not just single country. You've got a lot of different runners and riders in making up the Eurozone. The German economy has been particularly strong. The PMI surveys of the last couple of months have been nudging 60. Clearly France, post the election of Monsieur Macron in April, has seen a big improvement in business and consumer confidence. A lot of suggestions at this stage, perhaps not as clearly resolved through legislation, but a lot of suggestions that there's going to be quite a reformist programme which will take away a lot of the cost overhead that has undermined the recovery in the last few years in France in particular. So those are the two big markets for real estate in Europe. We don't really look much at Italy. Belgium and Holland are quite small by geographic and population standards. There's still quite a bit of oversupply in both Brussels and Amsterdam of office space. Dublin in Ireland has been very buoyant because obviously it's the one big English-speaking office area that might benefit from City of London financial sector jobs being relocated out of the UK post-Brexit. So Dublin is very buoyant. There are not too many real estate companies with quoted assets in Dublin, so it's perhaps quite hard to access that as an investor. And Spain, we like Spain. The economic recovery there has been solid, much better than people might have feared 3 or 4 years ago. But again, there aren't a plethora of quoted real estate companies. There's a lot of residential plays, which is something that we don't really want to invest in for our client base. But commercial real estate, you're pretty much limited to Madrid and to Barcelona, and there are no more than a handful of quoted property companies that offer you that access. We are starting to see a few new vehicles coming to the stock exchange that offer exposure to European real estate. I think there was a dearth of those over the worry years, both during the financial crisis and amongst the Eurozone crisis 3 or 4 years later. No one felt that it was appropriate to try and float anything. There was very little investor demand for such a beast. Whereas now we've seen one that listed this time last year. We've seen 2 more being mooted for listing in the 4th quarter of this calendar year. So it looks as though investor appetite for European real estate is definitely increasing. In the UK, for much of the post-financial crisis period, it's been London has been one story, and the rest of the UK has been a completely different story. So London saw quite a rapid bounce in capital values, a big increase in rents, and that was mainly down to the fact that the financial crisis had killed the development cycle. So there was absolutely no new supply. What normally happens in real estate is when demand goes up, supply expands to provide the space. And so you don't really get the natural rental growth for more than a year or two. This time round, the rental growth was there and the supply hasn't come. So rental growth has kept going. And so London was really very buoyant through 2011, 2012, 2013. The rest of the country saw no benefit of that at all. Now you're beginning to see business confidence in the north of England improving. That's a consequence of the fall in sterling that followed the Brexit referendum vote. Tenant demand has been quite solid. Tenant renewals of leases has been good. Now the doubts are more about London and how London might lose from a messy Brexit in a couple of years' time. And then I think if we look at opportunities, so one of the big issues for us as an investor is how sensitive the rental growth projections and thereby the capital values are to projections of economic growth. And if we've got a lot of uncertainty about what the shape of economic growth in the UK might be in 2019, 2020, we're looking potentially for property angles that aren't correlated to natural GDP.